Hi, I'm Dr. Kevin Milo, one of the co-hosts of the Physician Empowerment Podcast. At Physician Empowerment, we're dedicated to improving the lives of Canadian physicians personally, professionally, and financially. If you're loving what you're listening to, let us know. We always want to hear your feedback. Connect with us. If you want to go further, we've got outstanding programming both in person and online. So look us up. But regardless, we hope you really enjoy this episode.
So welcome everyone to another exciting episode of our Physician Empowerment webinar. And today we're really glad to have Jason, our faculty member, with us again. Jason is a tax lawyer extraordinaire, and he's at the tax division of KPMG. That's what I think notably the biggest accounting firm in Canada, but he's in the law division and he practices tax law. And Jason and I went back quite a few years. We were dance mates in a dance class. That's how we started, but he's a super nice guy, super smart. And he extricated me from some tax restructuring bind, and I was stuck with another firm, not happy. But anyways, we're so glad to have him again. And today we're going to talk about taxation in real estate investing. What tips and traps, right? There's always those. So first of all, I've always been passionate about real estate as an asset class, right? There are other asset classes, like Robert Kiyosaki calls it people, paper, dirt. And so there's real estate, there's business, right? Real estate is dirt, right? And then there's stocks, bonds, portfolios, and then there's commodity, the four types. But there are many things unique about real estate, and I know a lot of physicians will be involved in real estate at different levels, or even if not in a rental, even their own house, that's real estate, right? And so there's some tax advantage in real estate. And so I just want to talk to Jason. We have a fireside chat, we call it. And so what are some of the unique features, tax advantages in real estate investing? Can we talk on some of those?
Yeah. First of all, happy to be here again. I feel like we're getting close to the end of the syllabus here. So I don't know what I'm going to do in a couple of months. I'm just going to, once a month, just turn on my camera and talk to myself, I guess.
Yeah.
Yes. No. So real estate is, we were chatting about this before, like, you know, who's the right person to talk about real estate? And I said, I mean, it's all the same rules. They're just, you know, applied to real estate. It's not, there's not, you know, the Income Tax Act does have like over 300 sections, and it's broken up into 20 different parts. There's not like Part 17, real estate tax. You know, the normal rules that apply everywhere else apply to real estate.
Right.
Real estate's just unique in how it's structured, the relationship. I mean, the idea of it, of course, or the dream, I think, is to buy a piece of real estate. You get paid rent, and that kind of covers off your cash flow and your mortgage and pays for itself. And then if the mortgage is paid off, then you kind of get the rent for yourself. That's, of course, the idea. But there's no special rules for that. I shouldn't say that. There are a few unique rules around real estate, but by and large, you get your rental check in, and you have to figure out what your expenses were. In that sense, it's kind of like each one is its own little mini business where you've got to manage your utilities, your insurance, your property tax, all these things that you get to set off against the rent. And that one of the unique aspects is really that, you know, if you go to the bank and you just want to get 5-year GIC, there's only so much variance between, you know, the big 6 banks we have here in Canada and the smaller credit unions and stuff. It's all pretty much the same product, right? Real estate is great because you have a lot of flexibility. Do you want to buy a house? Do you want to rent out your own basement? A lot of people do that. Do you want to buy an apartment complex, multi-unit residential? Where do you want to go? And then have that, you know, do you want to pay someone else to look after it for you? That's something you can rent up against rent.
Right.
Do you want to, in essence, pay yourself? So it's that kind of, I think, flexibility in the way that it's kind of its own business, and you have a lot of control and freedom over those cash flows, both in and out,
right.
What you're paying to cover it, and, you know, you can set your own rent. So yeah, it's that each is its own little business, really.
Right. And of course, there's a lot of nuances, right? So let's dive into what everybody has here is the personal residence.
Yep.
Right. So principal residence exemption, I think PRE, they call it. Of course, people know that we buy the house and then we sell it later, and then the capital gains is exempt. right? You keep 100% of it. And although the government is challenging that, right? But there's some stipulations. Are there any exceptions to this thing? Can you just buy your house, sell it, let's say within a year?
So I mean, the spirit of the law hasn't really changed. I of course know where you're going with this question is, it only applies to principal residences. That's of course the catch-all.
Right.
There's a definition in the act for what a principal residence is. The problem became you had a lot of developers across the country who would buy a house, renovate it, oftentimes in 6 months, flip it, sell it, buy another one. And in one sense of the word, a lot of times it actually was their principal residence. But at the same time, it was also really their full-time employment, which they were fully sheltering. So there's several ways, of course, the government could go to kind of crack down on this behavior, which they, of course, didn't like. And the way they've gone with is they've put restrictions, finally, people have been clamoring for it for a while, on the length of time you have to own a place before you claim the principal residence exemption on it. As well, you used to actually not even have to put a sale of principal residence on your tax return. It wasn't even reportable. So, and that was there's kind of the two-layered problems. You had people who were buying, selling, renovating, and generating what, in all essence, probably is business income because it's their business. But they didn't even have to put it on a tax return because they were sheltering under the principal residence exemption. So a couple of years ago, they fixed that first issue of no reporting. You now do have to report a sale of a principal residence exemption. And now they've layered in another one where if you don't own it for, I don't have the rule in front of me, I believe it's a year, then you don't get the principal residence exemption. And there's a couple exceptions for, if there's a death or a job circumstance changes where it's, you can't live there anymore. So they're trying to have a little bit of grace in there, but what they're trying to, of course, clamp down is the people who were buying and selling it very quickly.
Right. So I have one example, then I'll spice this scenario up a little bit. So there was a real case. I used to learned it from a real estate club. This is a number of years ago, but this is a builder. And actually one of my colleagues' wife is a builder, right? So this is real. And that's exactly like that. They built these mansions, then they live in there, they sold it, and they move on. But this guy was very efficient, this builder. And I think CRA can go back, 7 years? So this guy kept building, flipping. And one day, CRA knocked on the door and wanted to look at all these and say, hey, it's all less than a year. And these are all, what do you call that? They're not capital gains and they're not exempt, they're income. And so this guy had 7 years of tax to go back as income at top margin rate. On top of that, there's GST that he didn't pay. Yeah. So there was, and this guy, I think he went under. I think that's the moral of the story, right? So if any people that either A, you're in that scenario, or B, you're investing with somebody who's in that kind of scenario, you better watch out, right? If you're in a partnership. So, and
I did just do a quick search. So it is 1 year is the turnaround time, which again won't catch everyone because of course you could buy a real rundown place and renovate it for 2 years.
Yeah.
But again, that would probably still be business in the principal residence sheltered. Yeah. I don't think we don't want to spend the whole time on principal residence exemption, but there's lots of nuances with it. It is a fascinating. Yeah. It's such a beneficial shelter.
Right.
Of course, people have been playing games with it forever. You'll have people who buy whole quarter sections of land and take the position that, this is all my principal residence.
Right.
And there's court cases to support that with the idea of if the land is if it can't be subdivided, then there's strong arguments that all the land contiguous, directly connected underneath the house is part of it because you can't do anything else with it. It can't be legally subdivided. It happens a lot in kind of acreages and stuff outside the city where you don't have a right to subdivide.
Yeah.
The same token, if you're living in, I know we have a lot of Ontario people on the call, so this might not compute with their brains, but if you buy a principal residence that doesn't go up in value very much, but you perhaps have a cottage at the lake or something that does go up in value a lot, there's sometimes you're able to claim the principal residence on the cottage instead of the house. So again, you only get one per year. So, but you can kind of divide it up, and you can even you can claim one shelter half the time in one, half the time in the other. It all depends on.
Right. So what if I'm very entrepreneurial? I buy a house, I live on the upstairs, I reno the downstairs to be a legal suites or whatever. That's just the in thing. So then is it still your principal residence because now you got income now?
And that starts to turn into a bit of a mess. We'll get into that more in the masterclass in 2 weeks.
Right.
Because there are There are change of use rules. There are now, so yeah, you've converted the use from personal use to a business use of portion of the house.
Mm-hmm.
As far as to keep it, we'll get into all that a little bit more in 2 weeks. Keep it
Mm-hmm.
simple. I mean, the same rules generally apply. Where on the income flow, again, you should be able to deduct a portion of the utilities, the property tax, mortgage interest,
Mm-hmm.
Against the proportion of the house that the legal rental suite is taking up.
Right. Okay, since we're following on this train of thought, income versus capital gains, right? I think we're diving into that topic. So there's a lot of people who love to flip, right? They either buy a piece of land, flip, buy a house, flip, or some people do call, they even buy just the title and flip, right? In real estate in Hong Kong or maybe in Vancouver, Toronto, a while, right? The building was not even built 100 story. They flipped the 50th story 5 times before the high rise was built, right? So those incomes, right? They're not capital gains, are they?
I'll chicken out of this a little bit the lawyer ways and say, of course, it would depend on the facts, but it does sound like you've outlined some facts there where that's probably an income gain where you're carrying on a business, just flipping these, especially if we're just talking bare title, to land and property. There's kind of the concept I always refer to it as the tree and the fruit in tax. If the tree is capital and it bears fruit, which is income. So you have this question again, if people are just buying the tree, which is capital, then which bears income, then that's a capital gain. But if you're buying the tree to sell it and to sell it for lumber, then that's income. And of course, the tree can also be used to produce income if you want to hold on to it for capital. So it's nuanced, and there's lots of it's all questions of fact. And again, what's your intention? There's a primary intention test, a secondary intention test. It's a whole. But the way you've outlined it, buying and flipping and short holds, lots of transactions, maybe doing it on leverage. Those are the kind of facts that usually kind of shoehorn you into income treatment as opposed to capital.
And in the up market, which is like in Ontario and BC, right, and now in Alberta, right, in the up market, when up phase again, so people love to buy pre-sale condos. That's a big run of that, right? Pre-sell this, pre-sell that, and then they get in, right, and they get out, and the returns are very sexy, right? They promise you a lot of fast bucks returns, right? But I just want to impress upon everyone, right, that just like what Jason's saying, that none of those are capital gains, right? And so you just have to understand that. And once you factor in that if you're at a 50+% tax bracket, right, then you divide that whatever percent they promise you by half, right? And suddenly it may not be as appealing or sexy, right? So just something some people get just by that number, and the greed factor comes in and they can't see it, and just the glass is full of just dollar signs, so they can't see anything else, right? So then what is truly capital gain then? And how is it taxed differently?
So capital gain is going to be generally a property that you're buying for investment purposes with the intention of generating income from it. That's what capital property is in Canada. It's property that's used to generate income, as opposed to property that's bought and sold for itself generating income. That's more of a commodity inventory. So again, houses, yes, they're big, yes, they're expensive, yes, they're immobile, but they can absolutely be inventory, right? And the courts would definitely agree with that. So capital, though, is you're buying this property, whether it's a machine that's going to manufacture widgets for you, or whether it's a house that's going to generate rent for you. The idea is that machine or that house is capital property. Then if it appreciates in value, so the interesting thing about real estate is it's one of the few pieces of capital property that generally goes up. Most capital property is what we call depreciable capital property. Everyone knows this with cars. You buy it and whether they say half the value is gone within 5 years, or if you drive it off the lot, I can't remember what the premise is.
Right.
That's because it depreciates. Once you start using it, once there's wear and tear on it, it goes down. Same with that widget factory equipment, right? You get to write it off over time because it's going down. There's going to be new and more productive pieces of machinery to do that work in the future. And your 7-year-old piece of property has gone down in value. Real estate is unique in that even though a house or the actual fixtures on the land are properly characterized as depreciable capital property, in a lot of markets, it goes up. And this is we'll get into this a little bit more in 2 weeks. An important thing for people to keep track of when they're buying real estate and building their portfolio is you should be keeping track of land versus building. When you buy a piece of property for $500,000, it's incumbent on you to put a value on what portion of that is land and what portion of that is building. This is important for a couple of reasons, most particularly the reason of claiming that depreciation that I just talked about. Real estate, because as I said, is a depreciable asset, you get to write off a certain portion of that depreciable portion on the building over time to help reduce your income, with the idea being that this asset is in theory losing value, and you get to shelter some income because of that. Again, if you end up selling, so again, let's say 500,000, we put half and half, so half land, half building. So over the next 20 years, we write off, there's 4%, pretty standard rate. You've written off most of the value of that 250, but you're in a market where both land and building have gone up in value. So you end up selling for $1 million, 500,000, 500,000. So what happens? So in the land portion, you're selling it for 500, you bought that for 250, $250,000 capital gain. Nice and easy. On the building portion, you're selling it for 500,000. It had what we would call original cost of 250, but its true ACB adjusted cost base at the time of sale is close to, let's call it zero, because you've written it all off. So what happens is the first 250,000 that you sell for is what we call recapture. The idea being that you got a bunch of write-offs for 20 years, but in a way you didn't deserve them, right? Because the value actually didn't decrease, the value increased. So the government says, all those write-offs you got from business income, you now have to bring them back in all at once. So when you sell, you have 250,000 of just regular income, and then above original cost to 500 is capital gain again. So this is an important nuance of deciding if you want to take depreciation. You don't have to. It's optional every year, up to the maximum percentage you're allowed to take.
So you're talking actually about capital cost allowance, CCA, right?
Yes.
Yeah. So people heard about this. So Jason's just doing a long, drawn out, like real legal definition of CCA.
Yeah.
So, and you say it's about 4%, right? Like if you buy a car, a computer, a laptop, it's like a third per year, like in 3 years' time.
I think it might be 50% on laptops. Don't quote me on that.
But real estate, the building, whatever, the structure, you can write off 4% per year. But what Jason was trying to say is, but land does not. CCA does not allow. It's not, right? I read that.
Yeah.
That you cannot write that off against land, right? Because there's nothing.
Yeah, land is one of the two obvious examples of what we call non-depreciable capital property, which is rare. Again, most capital property depreciates.
Yeah, because some of you have done land banking, right? So if you do land banking, hey, that doesn't work, right? If you buy a piece of land and you rent it out to farmers, hey, that doesn't work, right? But that CCA gives you a nice depreciation tax write-off for the year, but it's a tax deferral, right? Like you say, at the end, there's a recapture.
If you sell for more, yeah. And so strategy some people will do is when it's time to sell then, so you don't want to realize this $250,000 of recapture, some people will transfer to a corporation and then have the corporation sell. And then that recaptured amount might be less in the company when you kind of, how you pull that all out. So
that's a perfect good segue, Jason, to go into personal versus corporate. This is an age-old. You go to every real estate conference, people ask, should I buy this property myself or should my corporation do it? So personal versus corporate ownership. So can you give us kind of a big picture, right?
Sure. And before we leave depreciation,
okay, sure.
And again, we don't have to talk about every topic to death because again, we have a masterclass in a couple of weeks.
That's right.
But one important one I want people to leave with is the idea of rental losses. So early years of investing in real estate, cash flow wise, you're often negative, right? Because you've got the big portion of the mortgage. Depreciation, as I said, you can write off and reduce your income. You can't reduce your income to below zero with depreciation. So you can't create a negative, you can't create an increase or create a rental loss from depreciation.
Right.
Just a small little nuance point.
Right on, yeah.
So you usually only start, if you weren't claiming depreciation, once you kind of start to have a profit, that's when you start to take depreciation in the future. So oftentimes it's 5 or 10 years out when you even start taking depreciation. So you don't have that recapture issue all the time.
Right. Yeah.
But yeah, personal versus corporate is And we talked about this in earlier master classes. If in a perfect world, just talking generally about investing, I think my strategy is generally apples to apples. Personal is better. The money's all out of your hand. It's simpler. You don't have that refundable tax problem we would have talked about in the master classes, where you have to pay money out to recapture it, to recover it, all these things. Especially if you have, it's only an apples to apples if you already have the money outside of the company. Because otherwise, if it's after tax income that you have to take out, then it's not apples to apples because you have to pay tax on it to get it out.
Right.
Real estate's unique because unlike a stock portfolio, there are liability concerns that come with real estate. It's also you can buy one share on the stock market for, as low as pennies. Can't buy a piece of real estate for pennies. So you are usually talking, even if you're just talking 5% down, you're still talking much larger numbers. And those much larger numbers are more likely to be inside of your company. And so that first piece probably is the most important of where are the funds to do the investing. If you built up a large surplus in the company, even if rental income is going to be subject to that refundable tax where you have to pay out dividends to recover it, all these things, just starting with a larger base inside the company is generally better. If you've got $1 million just sitting there in cash in the company that you could buy $1 million of real estate with, that's what you want to do. If you want to take that out with a dividend, right, you'd only have whatever, $600,000, $500,000 left. You obviously only buy half as much real estate. So I'm guessing that is going to be the deciding factor for a lot of the decision of personal versus corporate. Keeping it in a company does give you some liability protection for the shareholders, although as the portfolio grows, it might make sense to spin the real estate out into a separate entity to protect it from the main business operations. But at the same time, if you're generating losses, you probably want those to be with the other business operations. So kind of a give and take of maybe you keep it with operations for the first little bit until it grows and becomes profitable, then you spin off into a side entity while keeping the shareholder advantage and keeping the tax deferred starting seed money.
Right. So now, of course, the decision is not just based on tax, right? There's a lot of other things to consider. What tax is not number one is, let's say I have some money, right? So the number one question is mortgage, right? So by and large, personally held title mortgages are a lot cheaper than commercial mortgage, right? Commercial mortgage, you're going to pay the broker upfront, you pay the bank upfront, and the interest rate is usually higher, right? And so there's only rarely that the interest rate of commercial side and personal side is the same. I've encountered it exceedingly rare, but they're usually quite a few points higher. So that's the different story, right? So but there's always a sound barrier when you fly. There's always sound barrier. The banks will say, "Hey, doc, you got 5, 6, 7, 8, depending on the bank, 11. The highest I think is 18. You got 18 properties. They see you as a liability, and they say, "Hey, doc, sorry, I know each one of them are cash flowing, but sorry, you're too much of a risk," right? So by then you have to move to a commercial anyway. So that's a big piece, right? But tax is also another piece, right? Because as you're growing in your real estate portfolio, you need more and more money, and they may be more and more. Like maybe you start with an apartment and 20% down, maybe $50,000, right? But now you become 100, 150. So it becomes harder to pull the money out of PC, get spanked for 50%, and then you go and buy real estate, right? So more and more you put it in corporation. And again, so we don't want to talk into this whole thing, right? But there's always this discussion, personal holding versus corporate holdings. And corporate holdings, if you have rental losses, you've lost, you can go against your active income of your corporation, right? Let's say your PC or your holdco have other active income, you can write up against that, right? So there is something good about that. And what about eventually this tax capital gain exemption, this juicy close to $1 million per shareholder? So what would you say, Jason? Can that apply to a real estate portfolio?
But for the most extreme scenarios where I'd really have to twist my creative fibers in my brain, yeah, no, you're not going to be able to get the capital gains deduction on sale of your real estate investment portfolio. One caveat: if you're carrying on a clinic business and you have a clinic in a building that's tied to the operations of the medical practice, very different scenario. Might be possible to get the capital gains deduction on that. In fact, that's quite common. But no, assuming we're just talking about, hey, I built up a portfolio of 18, 20 cash flowing condos and apartment units and all these things, you're not going to be able to get the capital gains deduction. And that just comes down to the tests of actively carrying on business in Canada, the thresholds for being an active business. Again, it's not impossible, but we are talking very large operations, and that's probably become your full-time job at that point in time.
Right. So that's, well, thank you. The segue into the three axes. So there's always three axes you could deal with. One is income versus capital gain. Number two is active versus passive. Number three is personal versus corporate, right? So we're now stepping into active versus passive. So in the real estate business in Canada, I have neighbors. I have one neighbor who doesn't have a job, right? He does this full-time, him and his wife. He's a handyman. He could just build the house from scratch. And they have small strip mall, they have duplexes, houses, and they're both active. But then when I was doing my homework to declare real estate as an active business, they wanted 5 full-time equivalents, 5 FTEs. So what would you say, Jason, right? So if my neighbor gets audited, so and you say, hey, mine is an active business, not a passive business, what would you say?
And just quick correction there, it's more than 5 full-time employees.
Oh, so more than that's
you actually need 5 full-timers plus at least 1 part-timer is how we generally interpret that test.
Darn
so
it.
one little shade more difficult for you.
Right.
Yeah, and we've talked about this in our earlier masterclass about investment income, and it's just this threshold the government put in of if the main revenue source of a company is from producing income from property, as opposed to providing services, providing a product, so interest, rent, royalties, dividends, they just put in a bright line test. They didn't want to be in the business of figuring out is this handyman neighbor and wife putting in more work than someone who's maybe got half as many houses, because where do we put that line? So they basically said, if your business is employing more than 5 full-time employees, we'll call you an active business.
Right.
Then you get the small business deduction. You get out of these refundable issues with the income. Your business is going to be. So again, it's a great threshold to cross. But I've met people with 50 properties in their portfolio that don't need 5 full-time employees to kind of run it, right? More than 5 full-time, continuous at all points throughout the year. So it's, again, we are talking pretty big operations.
So let's push this a little further. So if, let's say you got a big enough portfolio and then you sort of hire people, you actually become a property management business as well. So that then does that morph into 5 FTEs, 5 plus, right? Because you got to hire people.
Like sorry, can you repeat your
so let's say my neighbor, right? Yeah. They get bigger and now they actually start hiring people and call themselves a property management business as well. Does that turn them into an active co? Because then they can hire people to do this and that.
Yes, I think CRA would probably be of the opinion that you have 2 businesses though, right? You've got your property management business, then you've got your rental empire, which is kind of its own activity and operations.
Right.
And I have seen this. I know many property managers that kind of, started off by building their portfolio, realized, hey, I'm pretty good at this. I'm going to start a property management business. But even if they manage their own properties and kind of pay themselves, yes, that's fine. The property management business, if it's over the 5 full-time employees, probably meets the test. But their rental income, again, the main business there is deriving income from property. Right. Probably not going to meet it. Because then it begs the question of, okay, well, can I just start a property management business and then charge myself in a way that kind of sucks up all the revenue and moves it into management company, right? So, I would be earning $500 a month profit on this rental unit. Right. I'm going to start a management company, grow this management services, and now charge myself $500 a month to cover it.
Right.
CRA got wise to that. CRA's opinion is that you can kind of only, I think it's 15% is what they accept as an okay markup on your costs of actually delivering these services. So again, you can't cleverly dance around it usually by just management service feeing yourself out of the problem. But
now we spent a little bit more time in this segment, but I think it's important because a lot of us have this aspiration of growing big and have that 5 FTEs, right? But they're just like Jason says, it's not as easy as you think. So by and large, it is passive income, right? By and large, most people have capital gains and it's passive income. If you're hiding in the corp, PC or holdco, hey, watch out for that erosion into a small business deduction, right? If you collective income and not just you and your spouse and whoever else, then it eats up the small business deduction in no time, right?
Yeah. Yeah, and again, and that's again the unique aspect of real estate. The depreciation kind of helps with that. You can, it's once you're earning more than $50,000 a year in investment income, you start to lose your small business deduction on a 5-to-1
ratio. Yeah,
yeah, $50,000 and $1 erodes $5 worth of your small business deduction. So by $150,000, you're gone. But again, things like depreciation. Instead of managing it yourself, hiring a property manager so you have more time to do other things anyways. There's ways to kind of, in a way, as opposed to a stock portfolio or GICs,
right,
to manage that investment income. Again, you can front load renovations or builds or things like these to
right. Now, while we're on this topic, let's slide over to talk about JVs. In real estate, they all talk about if you want to be big, you got a JV, you got to syndicate. So partnerships, right? They're different. They just called JV. I don't think there's a taxation terminology called joint venture, right?
No, there's really no. Yeah, it's interesting. The term joint venture, I don't think is mentioned anywhere in the Income Tax Act, but it is a legal structure. I've put people in joint ventures. I've reviewed joint venture agreements. They are very much a thing. I think it's Syncrude. Talk to Syncrude. That's all joint ventures, kind of up in the oil patch here in Alberta. So JVs, and they are. What's interesting. They are mentioned explicitly in the GST Act, the Excise Tax Act. Joint ventures are. It's weird. They are kind of contemplated and addressed a little bit in GST, but Income Tax Act completely ignores them. But so yeah, a partnership is it's defined under provincial law pretty uniformly as two or more people carrying on business together with a view to profit.
So then let's do the simplest thing. Piece of paper, you and me 50-50. So with the light of what we just talked about, right? So then two or more right now becomes everybody is encroached in the same related company, right? So when this small business deduction, right, you got the income coming in, eat up the small business deduction. Whose small business deduction? Right? If me and my wife, you and your wife, and third guy and the spouse, so does it eat up? Are they all related? Because the SBD is related businesses, right?
So yeah, the small business deduction is tied to associated groups. So you and me get into business, we both have a company, we're not going to be associated. And if we have a partnership carrying on. That said, there's also, the partnership acts are pretty clear too, that just putting property in joint title doesn't make you a partnership. It has to be a little bit more than that, a little bit more intention, a little bit more business activity being carried on than just we jointly buy a piece of property, both of us are on title, and we hire a property manager to look after it. We don't think about it ever again. Query if that's actually a partnership there, as opposed to you're the finance guy, I'm the handyman guy, and we're really going to take a run at this, and we're both quite active in it. Totally, very different. Again, joint ventures, again, they don't quite have nice, convenient definitions like the partnership one I just recited. They're more thought of as standalone ventures, fixed periods of time, where parties are making contributions and agreeing on kind of usually a fixed percentage of either the revenue or the product. So again, if you're farming joint venture, maybe you're going to get, you and I, we enter a farming joint venture to make wheat, grow wheat. And we're both going to get 50% of the wheat produced by this group, right?
Right.
That's a little bit more, as opposed to a partnership where the partnership kind of, it would take the wheat, it would sell it at market, it would take its own costs, and then you and I would take kind of 50-50 of the profit of a partnership. In the most classic sense of a joint venture, it's much more of you and I are going to team up to make some wheat. We're both going to take half of the wheat, and then we can do whatever we want with our half. Maybe you're going to keep it, put it in a silo and make bread with it. And maybe I'm going to take mine to market and sell it. So again, JVs have evolved from that classic, that more classic model I just described, where I'll be honest, a lot of times a JV looks a heck of a lot like a partnership and it's very difficult to tell the difference.
So taxation wise, so once you make a killing on that condo or whatever, or on that apartment, then how does it get treated? Like that versus maybe like it's a limited partnership. How is it treated differently?
For a joint venture, a partnership, or a limited partnership?
I want both, like a informal JV, just you and me, versus a formal limited partnership. Taxation-wise, when you get all these real estate gains, how are they taxed differently, or are they the same?
So a partnership is going to be, so the way partnership taxation works is you calculate at the partnership level and then you allocate it based on the partnership agreement. So if it's a general partnership, then we're probably just going to take 50-50 out of that. That's probably what the agreement says. And if there's no agreement, that would be probably the assumption of the court is it's 50-50. Limited partnership, without going too far down the rabbit hole, the agreement's probably going to say what the limited partners are entitled to. They're probably entitled to a kind of preferential return based on what the 8% return or something, or all of the capital gains from the property. Again, partnerships are great in that they're contracts between the parties that can kind of say whatever you want, but that's also can be a very complex thing, as you can make them say whatever you want. So most of the investment probably goes to the limited partners there. Joint venture is more like the general partnership, but again, a little different. You and I would both just take our 50-50, but then we would both kind of on our own deduct our own expenses that we had involved with the property, with selling and all these things. Again, I tend to be a little pickier on the distinctions between joint ventures and partnerships than even some tax people that I know who, again, it's become a very blurred line in the last decade.
In real estate world, they kept talking about JVP, joint venture partner, right? So now I don't want to, again, beat the fish to death, right? But a lot of us who are getting bigger, right, and some of in the audience, they're already in this space. I just want people to be cognizant that taxation-wise, there's a lot to think about. Right. And even in a limited partnership, you get a slip, a T5053, I guess that's what it's called, right? And it is passive. It is not active, right? It's another passive income, right?
And it's, you're right. For the people on this call who are going out and reviewing documents, like, it's difficult. And a lot of people don't understand these nuances. Again, they're used interchangeably. Joint ventureship, a partnership. I remember the last file I worked on that I was advising on a joint venture, I wasn't drafting it. I was just reviewing it. And when I got it back, when I got it from the other lawyers, I looked at it. This is a partnership agreement. In fact, I'm 99% sure they just took a partnership agreement, changed the name, changed a couple terms, and we're hoping it was a joint venture. But I said, look, you drafted a partnership agreement here. We have to change a bunch of things if we want this to be a true joint venture. And we did. We had very specific reasons we wanted a joint venture. It was tied into real estate and all these things. We were trying to preserve the small business deduction because we had someone who had more than 5 full-time employees and was starting a new real estate investing venture. And fireside chat, hopefully I'm not going too far down the rabbit hole. If that person who had more than 5 full-time employees doing some real estate developing activities, if they did it in a partnership, partnerships have to meet that more than 5 full-time employee test by themselves. So each partnership is its own business and has to meet. If we could structure it as a joint venture, we were of the opinion that we could use our 5 full-time employees up top. Because again, when you're a joint venture, you're kind of involved in the business as opposed to a partner in a separate business. If that, again, splitting hairs, people on here are probably rolling their eyes with some of these distinctions I'm making. But all in all, it was very important for us to be a joint venture that time and not a partnership. But again, when we kind of redrafted it like 3 or 4 times because it was still basically a partnership agreement, but I was very picky about making it a joint venture.
So suffice to say that, boys and girls, if you want to go into a joint venture with somebody else, consult a lawyer first. Now let's go to some more day-to-day stuff. So you touch upon it is in the question that if you have a medical practice and you have a building, you're selling it. So can you expound on how juicy that could be? Like now you can use the real estate, which is part of the clinic, which is the clinic, as capital gains exemption, part of that. The lifetime.
Yes, the idea, I don't have the exact wording in front of me, so be gentle. But yeah, the idea is that if you own shares of a company that derives its value from, so the test is if more than 50% of the value in the last 24 months, more than 90% at time of sale is used in an active business carried on in Canada, primarily in an active business carried on principally in Canada, you get the capital gains deduction, that $1 million shelter. So to summarize that, active business assets is what you want. At time of sale, 90% active business. But if the assets of the company are used by another company that's related to it or associated, I should say, then that company is also a good company for that test, and you can get the capital gains deduction. So if you have a company that owns a building and leases it to a PC that's carrying on a medical practice, then yeah, that's even if the PC might not be sellable, it might just be a practice area where no one would buy it, but someone would buy that building and the clinic, then you might be able to get the capital gains deduction on those shares.
That's nice.
Which is fantastic.
Pretty nice, yeah. Okay, so one more and then we'll end the formal session. So would you mind explaining differences between the GST/HST new housing rebate versus the GST/HST new residential rental property rebate?
Put on the spot, I can't give you a great rundown on them, but I'm happy to use it as a teaser for the masterclass where
Sure,
I can
that'll be a good one.
A little more detail. And because again, they're very finicky in particular, I don't want to misspeak since I don't have them on the top of my head.
Right. Now, GST, it is a topic because people do get caught in it. But I can share that when we're buying houses for rentals, right? New builds, you can reclaim some GST, but there's a ceiling, right? The bigger the house, the less the GST, right? And I think the cutoff is like $350,000 or something like that.
Yeah, the cutoff is laughably. I don't think the cutoff's been adjusted since like the 90s. So the idea is if you build or buy a new home, you get. The idea is that for a lot of things, obviously GST doesn't apply, right, to food, these necessities. The idea is government says, okay, well, housing you should also get a partial exemption for housing. That's a necessity that people need.
Yeah.
So if you buy or build a new house, there's a forgiveness for GST because ordinarily the houses would be subject to GST.
Right.
But it is like laughably small. Like it basically is inapplicable to Ontario and BC. Like it's
right
because it starts to get phased out. Yeah, like the 300 to 400 range, and it's gone by like 500,000. And show me a new build in Ontario or BC that costs under 500,000.
Yeah, exactly. Yeah.
And even then, it's only a portion. I think it's a third of the GST or 2/3.
And then there's a new federal incentive for new builds. There's no GST, right? So I don't know when that's going to kick in, but a lot of builders are banking on that.
Yeah. And then one of the topics we'll talk to about in 2 weeks, there's a lot to talk about. There's also a bunch of new rules coming in to kind of put some clamps on some things. We have the, underused housing, the UHT tax that's coming in. There's vacancy taxes. There's Airbnb rules that are coming in some jurisdictions. So while we talked about how great real estate is, I think, if anyone here has opened a news website or a newspaper, you can tell that there's a lot of heat on the government to get some real estate to the market. So, and I think we're starting to see some policies that really is making it a little more nuanced, the decision of what the compliance costs are of being a real estate investor. And so we'll talk a little bit more about those in 2 weeks as well.
Sure. Well, that's a perfect place to wrap up. Thank you, Jason, again, for a lot of wisdom, lots of knowledge and experience. And so, so for anyone who haven't been signed up with the masterclass, please do. It's totally of good value because we do deep dives on these topics. So in 2 weeks, we're going to talk about deep dive of real estate investing as part of the advanced tax planning, right? So Jason will be back and we'll deep dive it.
Thank you so much for listening to the Physician Empowerment Podcast. If you're ready to take those next steps in transforming your practice, finances, or personal well-being, then come and join us at physempowerment.ca, PHYS empowerment.ca to learn more about how we can help. If today's episode resonated with you, I'd really appreciate it if you would share our podcast with a colleague or friend and head over to Apple Podcasts to give us a 5-star rating and review. If you've got feedback, questions, or suggestions for future episode topics, we'd love to hear from you. If you want to join us and be interviewed and share some of your story, we'd absolutely love that as well. Please send me an email at kmilo@physempowerment.ca. Thank you again for listening. Bye.